So there are a lot of things going on in Europe due to the conflict between Russia and Ukraine. And this conflict has heavily impacted energy prices in Europe. And I'm sure you read about this in the press on a daily basis. And we as well have to spend a lot of time analyzing what is going on and trying to figure out whether it's actually safe to invest in Europe or not. So today I'd like to address this particular topic and come up with the conclusion that yes, there are opportunities in Europe, but one has to be very selective. And I'll explain a little bit in detail how we approach this issue. If we think about the problems in Europe, there are three big areas that create a problem for the European society, the industry, and partly relate to the utility industry as well. The first one is energy prices are extremely high in Europe. It started with the Russian gas being cut off. That caused an explosion in gas prices. As a result, coal and oil prices started to trend up as well, and it's causing inflationary pressures everywhere, and it's causing the price of energy to be too high. If you think about it, it does mean that you do not want to be exposed to companies that rely on gas or coal to generate their products or to create a margin, because the margins are getting substantially squeezed. We think that within Gloin, the green shift is giving us an alternative, because renewables operators have a very low marginal cost of production. They are not exposed to gas or coal, and actually they're gaining market share in this. So not only by investing in renewables can you avoid the risk, you can actually benefit from it over the longer term. The second risk is even more complicated. It's related to government intervention. Because of what happened, electricity prices have gone up substantially, and that is leading to a lot of problems for consumers. If we look back, last year, European consumers paid between 2 and 3% of the household budget to the electricity bill. If nothing happened and we apply the current electricity prices, they won't pay 2 to 3%, they will end up paying between 8 and 12% of the total household bill. So it's normal that people are upset and unhappy, and if nothing happens, it will cause social unrest, because a lot of people simply cannot afford to pay that bill, or if they pay the bill, it means that they have to cut back on spending in other areas such as leisure, clothing, buying gifts for the kids' birthdays, going on holidays. And that obviously upsets people. So it is putting pressure on local governments to come up with a solution. The initial solution that we have seen so far has been put in place by individual governments. And the problem is that each and every government came up with a different plan. And that is not a good way to approach, because Europe is a very interconnected society. And so by coming up with one plan and another, but your neighbor doing something else, you create competition in between countries and you don't solve the problem. So we've read a lot about this. It's created a lot of confusion in recent weeks. Confusion that has impacted the share prices of utilities, but we think that there's a better path going forward. The European Union has seen this and has said we would be better if we put in place a common solution, a common framework that applies to everybody. They came up with a plan that is based on 2 pillars, and the plan actually got approved in Parliament last week. It still requires some details to be worked out, but we think that the plan will be applied by most member countries of the EU going forward. There's a short-term solution, and then there's a longer-term solution as part of the plan. The short-term solution is to put a cap on electricity prices at 180 euros. Note that the spot market price of electricity is 500 euros today. So it does solve the problem for consumers by avoiding them having to pay exorbitant prices for their electricity. The longer-term solution consists in reforming the electricity market to make sure that this sort of price volatility won't produce again in the future. Now, if we briefly look at the short-term solution, again, we think that there is an opportunity and a risk to it. Because 180 euros per megawatt hour, which is where the price would be capped, is about the level where coal-fired generation breaks even. If you're burning gas, you're losing money at 180 euros per megawatt hour. If you're burning coal, you're breaking even. If you're doing renewables, you still have a very healthy margin because your production is much lower. We think that 180 euros is the right level to cap, because if you went lower, coal-fired power operators would shut down production, and then you would have even less electricity. And that's where we started the problem. There's not enough electricity. So we think that the level will stick at around 180, but it also means that you don't want to invest in old school coal-fired power operators because they won't make money. They just barely break even. But if you invest in renewables operators, remember that these operators used to sell their electricity at around 50 to 60 euros per megawatt hour. With what happened this year, they're probably making about 75 to 80 euros per megawatt hour. So this is already a nice evolution for these operators. But if you're making 75 euros per megawatt hour today, and I tell you that you risk being capped at 180, you don't worry too much, because the cap is way above where your current business sits. And there's room to grow the profitability even further before you hit these types of caps. So again, we think that being selective in which companies you invest in and positioning yourself along the green shift and along renewables operators is the right way to approach this. And we think that due to the current uncertainty in the market, current share prices don't reflect this, because all of the shares have suffered from the uncertainty, and we think that some companies will come to benefit better from this. And then a third group of risks that we see in Europe relates to overall inflation. High energy prices have filtered through the general economy and has caused inflationary pressures everywhere. And again, that is a problem if you're exposed to inflation, but you can't pass it through your revenues. There's a risk of a margin squeeze, and that's something that we're seeing in a lot of industries. I think partly in the utility industry, there's room to avoid this, because some business models in the European utility industry have mechanisms in place to pass through inflation. Think about the regulated businesses in transmission and distribution in the UK, for example, or in Italy. That is a regulated framework that inflation adjusts the business model every single year. And so these companies will grow in line with inflation, whatever happens. But there's also a whole group of utility companies, again, usually found in the renewable space, that have long-term power price contracts in place with the clients. And the long-term power price contracts typically consist of a fixed price with an inflation escalator on top. So as inflation goes up, the contract gets adjusted every single year in line with inflation, allowing them to grow their earnings as inflation filters through. So when we look at the Gloin portfolio, we are cautious on Europe. It's also the reason why Europe is only 23% of the portfolio and US is close to 70% of the portfolio. The reason is that the US is much more defensive and Europe is much more at risk. But we do think that within the risk, a lot of stocks are cheap today. And so if you can find the right ones by doing proper bottom-up analysis, we do think that we can buy good stocks today that will generate very good performance going forwards. So hopefully that clarified a bit the complexity of the situation in Europe, but very often when there's complexity, there are opportunities for investors that are willing to take educated risks. I would like to thank you very much for your interest in Gloin, and have a very good day.